Okay, so we're looking at prepaid expenses next. So, if the assets future economic benefits is taxable, the tax base is equal to the future tax deductions. So if SARS allows a deduction of prepaid expenses with the expenses incurred, right, and not paid. So remember, with a prepaid expense, it would be, well, generally, we are going to pay in year 1 and then incur in year 2, right? So if SARS allows a deduction when the expense is incurred, so in year 2, when it is incurred, it means that there will be a future deduction. So in year 1, there will be a future deduction, right? So the tax base would then be the future tax deduction, alright? So if the deduction happens in year 2, when it is incurred, there's a future deduction. In year 1, there will be a future deduction, and then the tax base will be the future deduction. However, sometimes SARS allows a deduction when the payment is made, so in year 1, alright, because remember we're looking at the prepaid expense now. So when the deduction is allowed when the payment is made in year 1, the tax base will be 0 because there won't be any future deductions, right? So there won't be any future deductions because the deduction happened in year 1. So in year 1, there won't be any future deductions. So let's look at an example quickly. So the profit before tax, before the expense taken into account in year in 2018. So the profit before tax is 20,000 in 2018 and 2019, and this is before the expense taken into account. So the expense was paid in 2018. Right, it will be incurred in 2019. It amounted to 5,000 Rand. The full payment will be allowed as a deduction in 2018. So from the two scenarios that we have over here, we will have the second scenario. Right, the second scenario, the tax base will then be 0 because the deduction is allowed in 2018. So 2018, there won't be any future deductions, so our tax base is 0. So, when we look at our deferred tax asset, to calculate our balance sheet approach, our table that we use, opening balance is 0, right? The closing balance, so we have an asset, so it's 8,000. Our tax base is 0, so we'll have a taxable temporary difference of 8,000 Rand. Our deferred tax balance is 2,240, and it is a liability because our carrying amount is more than our tax base, right? Deferred tax liability because we will have a liability in future, right? And then in year 2, right, our closing balance is 0, tax base is 0, our deferred tax balance is 0. So we have a deferred tax adjustment over here of 2,240. We have our current tax calculation. You guys can go through this. I'm not going to go through this on my own. I'm not going to go through this again with you guys. So you can go through this by yourself. Because all of them are generally the same. The only thing that I'm trying to show you guys is how we determine the tax base. So you guys can go through the rest of the things on your own. Let's look at accrued expenses. So for accrued expenses, the tax base. So if the liability represents an expense, right, we calculate our tax base by saying the carrying amount minus the future tax deductions. So for expenses, SARS generally allows a tax deductible expense to be deducted when they have been incurred, irrespective of whether they've been paid or not. So if the future deductions are 0, it means that the tax base is then equal to our carrying amount. So if we look at the example, we have profit before tax is 50,000 Rand in both 2019 and 2020. According to the accountant and SARS, but before taking into account the following information. Telephone expense of 6,500 was incurred in 2019 and paid for in 2020. So we had an accrued expense in 2019, right? So SARS will allow the expense to be deducted in 2019. Alright, So they allowed the deduction to be allowed in 2019 when it is incurred. So no payments were made to SARS, and there were no other temporary differences. So because the deduction was allowed in 2019, our tax base is equal to our carrying amount. So our carrying amount for our accrued expense was 6,500. We have the tax base of 6,500, so there's no temporary difference, right? Okay, and so moving on to provisions. Alright, so for provisions, provisions and accrued expenses are not necessarily the same. So due to the fact that the provision has a certain degree of uncertainty, SARS may not allow a deduction when it is recognized. So generally the deduction is allowed when it is paid, right? So the deduction will then be allowed in future, right, when it is paid and not when it is recognized. So remember, the tax base is then equal to the carrying amount minus future deductions. So we will have a future deduction, so it means that the carrying amount and the future deductions are the same, so then our taxes will then be 0. And then you guys can have a look at this example again. So we have the carrying amount of our liability, which is the provision, 23,000. Our tax base is 0. Tax base is 0, temporary difference 23,000. So we have a deferred tax balance of here of 6,440. And then we also have income received in advance. This is the last one I'm going to do. Income received in advance. So again, we also have no temporary difference because, SARS and accounting, they treat they both recognize the income when it has been earned in the first year. Okay, and then continuing to non-current assets. So non-current assets are divided into two categories in order to determine the deferred taxation on it. So we have deductible assets. So the cost of the assets are deductible for tax purposes. We have wear and tear allowance. And so, I showed you guys how to do that. So in this example, I'll show you guys how to do that type of calculation over here. And then we also have non-deductible assets, and so the cost of these are not deductible for tax purposes. So deductible and depreciable assets, in a situation where the depreciation rate and the wear and tear rate is different, the carrying amount, the tax base of the asset will be different, which will result in a deferred tax. So please look at that example over there, example 9. And then we have the second type, which is non-deductible assets. So an example of a non-deductible asset is land. So then IS 12 paragraph 7 says that if the economic benefits will not be taxable, the tax base of the asset is equal to the carrying amount. So therefore there's a temporary difference on non-deductible non-current assets, but no deferred tax is recognized as the temporary difference is exempt. So you guys can have a look at example 10 and 11. So guys, please have a look. So I'm not doing an example with you guys. I want you guys to look at this example 10 and 11. I'm going to give you guys a big example, a consolidated example to do. So I won't be doing a small example. And then further for our non-current assets, so what about assets that we measure at fair value? So depreciable assets measured at fair value is out of the scope for FIA 225. Therefore we have to consider land under the revaluation method and investment property under the fair value method. So the tax consequences on land only arises on sale, and it is a capital gains tax consequence. And then investment property at fair value depends on management intentions. And you guys can have a look at example 12. So please have a look at example 12. And then also please have a look at the comprehensive example that I will add. And then we've covered enacted tax rates versus substantially enacted tax rate when we did chapter 5. But so for deferred tax, it says that deferred tax assets and liabilities must be measured at the tax rates that are expected to apply when the asset is realized or when the liability is settled. Alright, and it must be based on tax rates that have been inactive or substantively enacted. And then it further states that deferred tax assets and liabilities must reflect the future tax consequences. Okay, so rate changes. So a deferred tax balance is simply an estimate of the tax owing in future, right? Or the tax that's going to be recoverable from source in the future. So the estimate is based on temporary differences, right? That we know, temporary differences times the applicable tax rate. And if the tax rate changes, so does the estimate of the amount of the tax owing by or to the tax authority in the future. So therefore, if a company has a deferred tax balance at the beginning of the year, and then during the year the tax rate changes, the opening balance of the deferred tax account will then need to be re-estimated. Re-estimated, yes. So this is effectively a change in accounting estimate, and the adjustment for which is processed in the current year's accounting records. So the tax expense account in the current year will include the adjustment to the deferred tax balance from the prior year, and the effective tax rate in the current year will not be equal to the applicable tax rate. The difference between the effective and the applicable tax rate results in a need for a tax reconciliation in the tax note, and the deferred tax balance is always adjusted for the new rate unless the rate change occurs after year end. And so essentially what it is, I'll show you guys quickly. Right, so we have our opening balance. So remember, the opening balance is the closing balance of the previous year. So when we calculate our opening balance last year, our applicable rate was 30%. So let's say the temporary differences was 50,000. When we calculated our opening balance last year, our deferred tax was 15%, right? Then we had a rate change, and now we need to re-estimate our balance. Now we need to restate our balance at the new rate. So we say our temporary difference, it's exactly the same balance, right, that we had, but times the new rate of 28% over here. So our deferred tax balance now changes from 15 to 14,000. And remember, it's exactly the same balance. It's the opening balance. The only difference was we had a rate change from 30% to 28%. And so this adjustment must then be processed. So this rate change adjustment must be processed. We debit our deferred tax, and then we credit our tax expense. Okay. Then we have disclosure. So as we've already discussed, deferred tax must be disclosed as a non-current asset or a non-current liability. It cannot be set off against each other unless these two circumstances applies. We then also have to our deferred tax note. The deferred tax balance may reflect an asset or liability balance, and therefore it makes sense to explain in the heading of the note whether the balance is an asset or a liability. You must disclose the amount of the deferred tax asset or liability recognized for each type, the temporary difference for property, plant, and equipment, prepayments, and so on, tax losses and tax credits. Alright, and there's also a reconciliation note. You guys can please have a look at that in the textbook. In the statement of comprehensive income as well, so I'm running out of time quickly. We have the normal tax, and any other forms of tax considered must be to be a tax levied on the company's profits are combined to reflect the income tax, right? So we have our income tax expense note, right? And so this must comprise of our current tax, right? And then any under or over provision, and then we must also show our deferred tax adjustment that we had. And then there must be a reconciliation explaining why the effective tax rate differs from the applicable tax rate. Guys, please look at the example, and as I stated, I will add a comprehensive example as well, so please have a look at that as well.